Accounting for Managers, part 2. Okay, I'm just trying to maximize my screen here so that you guys can have better vision. There we go. So, accounting for managers part 2. This implies that you guys did accounting for managers part 1, and therefore there are certain underlying assumptions that I will make towards the conducting of this lecture. But if it so happens that I've made an assumption that you do not understand, you are free to ask, and then we can address the issue. So to begin with, I have decided to take the first topic on your curriculum for this semester, which is depreciable assets. So you are going to find that this is your unit 1, and we are going to talk about it now. And we'll talk everything that is there to talk about pertaining depreciable assets, and then we'll attempt your assignment question if the time still permits. So, so as we go along in the lecture, you are free to take your notes. I'm not going to be telling you, write this down, write this down. You just write what you think is of importance to you, or you just summarize what I'm going to be teaching. So depreciable assets, what this implies is that there are certain assets that are not depreciable. From the word of the topic, from the topic subject topic itself, you should be able to tell that there are depreciable assets and there are non-depreciable assets. So it is important that I make a demarcation between those two before we move on. So depreciable assets implies that those are assets that we can depreciate at the end of the period. Hence to say there are certain assets that we cannot depreciate at the end of the period. Which assets can we depreciate at the end of the period? The non-current assets in general. And which assets do we not depreciate? The current assets. So the non-current assets are the only depreciable assets. And therefore, in this chapter, we are going to be looking specifically at non-current assets. And non-current assets refers to resources controlled by the company for a period of more than 1 year. I assume this you have learned in your previous semester. And then almost all non-current assets fluctuates in value. So almost all, it implies that there are certain non-current assets which does not fluctuate or which does not depreciate. So some non-current assets will appreciate in value, but many will depreciate in value. That means it will lose value over time. So examples of non-current assets which appreciates in value over time are real estates. You buy a house today and you try to sell it 5 years from now, you see that the price of that house would have increased. Why? The increase can be attributed to factors such as inflation and many other factors. So with the exception of real estates, any other non-current asset loses value over time. And this loss in value is referred to as depreciation. So why do I say an asset loses value over time? Suppose you buy a car today and you want to sell it after 5 years' time. You obviously don't expect to sell it. Suppose you buy it today for 200,000 Rand. You obviously don't expect to sell it after 5 years for that very same amount. Why? Because you understand that you have used your car. It is not in the condition that it was in when you bought it. And therefore, it has lost its value. And that loss in value is what we refer to as depreciation. Okay, so depreciation is an adjustment which happens at the end of the financial year. So you'll find that if your financial year starts on 1 January, on the 31st of December, you are bound to calculate depreciation. Remember, the duty of an accountant or of the accounting function of a business is to provide a true and fair view of the business at the reporting period. So when it comes to the end of the financial year, we are keen to present what we really own, or we are keen to present the non-current assets in a more realistic value. Therefore, we understand that the value of assets or the cost that we purchase the assets on is not the same at the end of the period. And therefore, we would like to show that in our books of accounting so that the books of accounting shows a true and fair view of the business. So you find situations whereby you acquire an asset for on 1 January, and then you want to sell the asset on 31st of June, on the 30th of June, sorry. That implies that the asset did not stay for a year and therefore should only be depreciated for the amount of time that the asset stayed with the business. We cannot go on and depreciate the asset for a year while we know very well that we only kept the asset for 6 months. Or we find that it's not a new asset, it has worked for 5 years, but in the 6th year, we decided to sell it halfway through the year. And therefore, we must account for depreciation for that halfway and not the full year. We'll take note on that when we try to attempt an example. Then when you talk of depreciation, there are two main methods which are involved. The first one is the straight line method, or you might find that sometimes they write the fixed installment method. So when you see these two words being used interchangeably, don't get confused. It's one and the same thing. The method of calculation remains the same. So that's the first method of depreciation. And the second method of depreciation that we have is the diminishing balance method, or the reducing balance method. I will explain later why we call it the straight line, why we call it the diminishing balance method. So to begin with, we want to look at the straight line method. So the straight line method entails a situation whereby a certain rate, a predetermined rate, is applied to the cost of the asset. So we are given a rate of depreciation and the cost of the asset, and we are required to calculate the what? The depreciation. So we just find the percentage. It is usually given. Sometimes they tell you depreciation is 25% using the straight line method. So you just apply that 25% to the cost of the asset. So with this method, the value of an asset is reduced uniformly over each period. What do I mean? I mean, you'll find that if the rate is 25% and the cost is 20,000, each and every year until the asset is disposed, is going to be 25% of 20,000, 25% of 20,000, because it's the same rate being applied to the same cost. That is why they call it the straight line. It's one and the same. We are doing the same thing over and over again. So the depreciation charge for each year is the same up until the value of an asset comes to zero. So that's it about the straight line method. I would like us to look at an example pertaining the straight line method, and then we will move on to the diminishing balance method. Just minimize my screen. So the example reads, on 1 January 2020, Arava Bearings bought a delivery van for 500,000 Rand. Calculate, number one, is depreciation for the year 2020. Number two, calculate is depreciation from 1 January 2021 to 30 June 2021. And then the requirement is prepare the depreciation and the accumulated depreciation accounts in the general ledger of Arava Bearings. So the first thing that we do is to calculate the percentage, or is to apply the percentage. I'm just realizing that the percentage has not been given in this question. So let me just put the depreciation percentage is 25% using the straight line method. So we want to calculate the depreciation charge using the 25% rate that we have been given. So the first thing that we do, it says here, we want the depreciation for the year 2020, the depreciation for the year 2020. So we want to see when was the asset bought? It was bought on 1 January 2020, and we are asked to calculate the depreciation for the year 2020, which obviously ends on the 31st of December 2020. So you want to calculate depreciation for the whole 12 months. So we've been told that it's 25% and the cost is 500,000. So what we want to do, I'll just use a different slide. What we want to do, we want to write the cost, 500,000, then depreciation rate, 25%. And then we want to come here and say year 2020. This is where we are going to put our charge. So I have said before that we are just going to apply the rate to the cost. Just applying the rate to the cost. So what do we say? We say 25% multiplied by 500,000. So that would be the formula for the calculation of depreciation using the straight line method. So when I say you apply the rate, you just multiply the rate by the cost, and then 25% per annum. Yes, it's 25% per annum. So we want to apply that 25% to the cost of 500,000. So we just come and say, mathematically, 25% is the same as saying 0.25. So you want to say 0.25 multiplied by 500,000. We'll find that our depreciation charge for the year 2020 is 125,000. So we just come and present it here, 125,000. But that's not the whole question. We've just attempted part one. We now want to attempt part two. Part two says calculate its depreciation from 1 January 2021 to 30 June 2021. So we come and say January to June 2021. January to June 2021. So we know that if we are doing this depreciation, if we are calculating depreciation using the straight line method, the depreciation remains the same. But we must take note that in this particular instance, we are not calculating depreciation for a full year. We are only calculating depreciation for 6 months. So what do we say? We say 25%. We multiply it by 500,000. When we multiply 25% by 500,000, we will find the depreciation charge for the whole year, that is 12 months. But take note that we only want depreciation charge for 6 months. So we go on to multiply by 6 over 12. So when we multiply by 6 over 12, we are trying to take the portion of the first 6 months of the year and leaving the remaining 6 months of the year. So that's just what we do. That is the formula for calculating depreciation. If we were asked to calculate for 3 months and not 6 months, we'll just come to the 6 year and put the 3 months that we would be asked for. But in this example, we are asked for 6 months, so we put the 6 months there. And then we go on to perform the necessary calculations. So 25%, which is equivalent to 0.25, we multiply it by 500,000, and then we multiply it again by 6 over 12. So 6 over 12, it's as good as saying 0.5 because it's 1/2. So we can just simplify it to 0.5, which gives us 62,500. 62,500, which means deposit for depreciation, I mean, for the first 6 months was 62,500. And therefore, if we say 62,500 multiplied by 2, which is the number of 6 months that we have got 2 6 months in a year, the first 6 months, January to June, and then the last 6 months, July to December. If we multiply it by 2, we'll find the total depreciation for the year. We'll find the total depreciation for the year, which is 125,000, the one that we found here on top there. So it's only a matter of apportioning. That portion which belongs to the first 6 months is what we were asked by the question to present, and we have calculated, but we have not yet done justice to the question, because the question reads, prepare the depreciation and accumulated depreciation accounts in the general ledger of our rubber bearings. So we want to do just that which the question is asked us to do. Okay. So we want to prepare the general ledger of our rubber bearings, and I suppose you know how the general ledger looks like. It has got a debit and the credit side. The debit side is composed of 3 columns: the date column, the details column, and the amount column. And then the credit side is composed of the same: the date column, the details columns, and the amount column. So we just want to put borders there, and then we provide for the demarcation here. And then this is the debit side of the ledger, of the journal, of the ledger, that's correct. And this is the credit side of the ledger. And then in the big, on the middle here, we put the name of the what? Of the account. So when we want to record to the ledger, we always have 2 ledger accounts. We always have 2 ledger accounts for each transaction. That's to complete the double entry concept. So the first account that we have here is obviously the depreciation account. And then the second account that we will have, I want to put it here. Let's just check this column and put it here. The second account that we will have is the accumulated depreciation account. So you find that I can write DPN, that represents depreciation. It's short for depreciation. So we've got the depreciation account and the accumulated depreciation account. So whenever you are posed with a depreciation question, you must know there and then the 2 accounts that are involved: the depreciation and the accumulated depreciation account. The accumulated depreciation account is sometimes referred to as the negative asset account. Why? Because as we apply accumulated depreciation, we are reducing the value of the assets that we have in our financial statements. And therefore, if we are reducing the value of an asset, it becomes a negative asset. Mathematically, if we put a negative sign to anything, it means we are reducing. So the accumulated depreciation reduces the value of an asset, and therefore it is referred to as the negative asset account. And of these 2 accounts, one account must be debited and the other one must be credited to complete the double entry concept. And to know which account is debited and which account is credited, we can use the, I suppose you guys learned this in your previous semester, but we can use the acronym, the acronym dealer. Okay, I'll write to you what does that mean, so that you never have problems when it comes to knowing which account has got what balance. You'll be faced with many accounts and you are bound to know which account contains which balance. So the first three letters have got a debit balance. Those are drawings for the D and expenses for the E and assets for the A. So those are the first three letters which have got a debit balance. And then the last three letters, it means they've got a credit balance because they are on the credit side of the T account I just put there. The first one are liabilities, represented by L. And then, okay, let's go to R as I think of the E. R is for the revenue. The E is for the equity. The E is for the equity. So drawings, expenses, and assets have got a debit balance. Liabilities, equity, and revenue have got a credit balance. I assume you were taught of these things in your previous semester. I assume you were taught of these things in your previous semester. So what is depreciation? Depreciation is an expense as we are reducing the value of an asset. Depreciation is an expense account. So we know there and then that depreciation is an expense account, and therefore all expenses have got a debit balance. All expenses have got a debit balance. When we say an account has got a debit balance, it means any event that increases the value of that account goes to the debit, and any event that decreases the value of that account goes to the credit. There to say, if depreciation is an expense and we found that at the end of the year we had a depreciation charge of 125,000, it therefore follows that we are increasing an expense. So to increase an account with a debit balance, we go to put the event on the debit side of the account. So you want to record um, the, the depreciation charge for the year on the debit side of the account. So we just come here and then we put the date. We're just told that is for the year 2020. So let's just write 2020, or we can choose to write 31 12 2020. That becomes our date there, and we go to put in the details. The details are always the name of the other account. The details are always the name of the other account. So the other account is accumulated depreciation. So the details become accumulated depreciation. I'm just using shortcuts for my columns there. And then at the end of the year 2020, we had a depreciation charge of how much? Of 125,000. So we just come to take it as it is. Then before we do anything, we go and complete the double entry for the transaction that we have just made. We go and complete the double entry for the transaction that we have just made, which means we go to the accumulated depreciation account. We put in our date. The date is the same. So I can just copy and paste. And then the details. The details I have said is the name of the other account. Right now we are in the accumulated depreciation account, and therefore the name of the other account is depreciation. Depreciation or let me just put DPN depict depreciation of how much of the very same
I think he's reconnecting. His network is acting up. So can you bear with us just for a moment while he's reconnecting?
Okay, very sorry about that. My network had left me.
And now they're going to buy a school a drink.
Very sorry about that.
Okay.
Now I'm back. I'm back now. So I was saying, I hope you have been told how to balance a ledger account in your previous semester. So right now we have recorded the 125,000 in the depreciation and the accumulated depreciation account. And that's the depreciation for the first year. We want to move on to the depreciation for the second year, which we have already calculated. So we have calculated the depreciation on what? On the 30th of the 6th month, 2021. It is very important that you cannot write in the ledger account mixing years. We could not have came right under 2020 and put 2021 without balancing the ledger. So if you are moving from one year going to the other year, it is a must that you must balance the ledger. In right now, our ledger is balanced. So we want to move on and take a depreciation for the following year, which we have calculated and came to 62,500. So from January to June 2021, the depreciation charge was 62,500. And the details that we put is accumulated depreciation, because this amount is going to the accumulated depreciation account. So we also come and fill in the accumulated depreciation account. And then the details or the narration of that transaction is simply depreciation, because we are taking this from the depreciation account, and the sum of how much? Of 62,500. So we have recorded our depreciation for the first year, and we have recorded our depreciation for the second year, but which was a half of a year. So we want to also come and balance the what? The account. So we just say 125 plus 62,500, and it gives us 187,500. We must as well put a double lines there, because it's our last transaction. Also here, 187,500. And then when we come here, it's the same 187,500. What it therefore means is when we go to the following period, our account will have a balance of what? Of 187,500. And again, I assume you have been told how to balance an account. In this particular one, you just write balance to be brought, to be carried down to the next period, and it's shortened to balance CD. So the debit side of the ledger must be equal to the credit side of the ledger. That is why you see I rushed to put the totals in the totals column, but we haven't recorded anything on the credit side. So that which is in the total column goes to the balance carried down, which is 187,500. This amount is what we are going to enter the following period with. and we call it balance brought down of 187,500. So this is how you balance a ledger account. We need to know at the end of the period how much was in that account so that we can go ahead and prepare the financial statements. So that's it in as far as the example that we had is concerned. So we were asked to present the depreciation account and the accumulated depreciation account, which we have done, and therefore you want to move on. I suppose you must take out this formula for when you know that an account has got a debit balance and when you know that an account has got a credit balance. So when we go to the statement of financial position, I assume you know the statement of financial position, and you'll find that it is written non-current assets, non-current okay, let me just write NCA. It means non-current assets. Non-current assets, and we are given the cost of 500,000. And then you see again, it is written right under non-current assets, they write accumulated depreciation, accumulated depreciation, and accumulated depreciation of how much? Of 187,500. This which we have calculated here. And then, which means that at the end of the period, we had assets worth 312,500. So the accumulated depreciation is deducted from the cost of the asset. The accumulated depreciation is deducted from the cost of the asset. Why? Because we want to show the true and fair view of the business as at the reporting date. So our asset as we speak right now is worth 312,500. If we are going to sell it right now, we must at least get this amount. And if we get anything less than this, it means we have made a loss on the sale of the asset. And if we get anything more than this, we have made a profit on the sale of the asset. So that is just about it. To say a few things about how accumulated depreciation and the cost of the asset are dealt with after presenting them in the ledger. So we would like to move on to the other method of depreciation, which I have said is the diminishing balance method. Is the diminishing balance method. So the diminishing balance method, we apply a fixed rate also, but we are now applying the fixed rate on the carrying value of an asset. Remember, on the straight line method, we are applying the fixed percentage on the cost. Right now, we are applying the fixed percentage on the carrying value of an asset. What is the carrying value of an asset? The carrying value of an asset is the value of an asset, the ones that we have calculated just now. We can call it carrying value. So it's the value of the asset subtract accumulated depreciation. This becomes the what? The carrying value. And you see the formula is here. So the carrying value is equals the cost of the asset subtract the accumulated depreciation. So when you subtract the accumulated depreciation from the cost of the asset, then you apply the depreciation rate. That is the reducing balance method. So you will see that if you say cost of an asset, you subtract the accumulated depreciation. What is left as the value of your asset is less than what was its cost. Suppose here, uh, uh, our cost was 500,000, and now it's 312,500, the carrying value. So we are coming to with the diminishing balance method, we are coming to apply the rate now on this current on this carrying value on or carrying amount. You might find them writing carrying amount and not on the cost like we were doing with the fixed depreciation, with the fixed with the straight line method of depreciation or the fixed installment method. So that's it to talk about the diminishing balance method. I would like to make more points by illustrating the example. The example that we are going to be using is your question number 1 on your assignment. Is your question number 1 on your assignment. So it's a bonus for you today. The question reads, question number 1, name the two most common methods of calculating depreciation. I'm not going to talk about this one. It's a give. And then I would like to talk about 1.2, which says Patek Platinum, a registered VAT vendor, bought a non-passenger vehicle for 305,325 rand, including VAT, on 31 May 2019. So he bought this vehicle on 31 May 2019. And then we are told all non-current assets are depreciated at 33.33% per annum, according to the diminishing balance method. So our depreciation rate is what? 33.33% per annum. Per annum simply means per year. And we are told that we are using the diminishing balance method. And then we are told assume a VAT rate of 15%. So in accounting, we use every information that we have been given. That's the rule, the golden rule of accounting. If you want to pass any module in accounting, you must know that we are given information for a purpose. And should we choose not to use that information, marks the beginning of our demise. So we must see where we are going to apply this 15% of VAT we have been told about. So what is the requirement? The requirement reads, prepare the depreciation and the accumulated depreciation accounts in the general ledger of Patek Platinum for the financial years ending 31 August 2019, 31 August 2020, and 31 August 2021. So these are what? 3 years. 3 years. Round off to the nearest rand. So we just want to take the information that is useful. We know that the cost of the vehicle is 305, 325. 305, 325. We can do away with this information. We have already used it. Okay. We want to do away with this one as well. So we are told that the cost is 305, 325. So the cost 305, 325. Depreciation rate, we've been told 33.33%. 33.33%. We don't want to round off here. We don't want to round off here. There we go. The depreciation rate is 33.33%. What else do we need? The VAT rate. VAT rate is 15%. And then we are asked to prepare the depreciation and accumulated depreciation accounts for the year ending 31 August 2019, 2020, and 2021. 2019, 2020, and 2021. 31 August 2019, and then 31 August 2020, and then 31 August 2021, 3 years all in all. But we are not sure yet if we have got anything that must be accounted for, not as a full year. What do we want to do here? We want to remove the borders. Here we want to remove the borders. Top. And right, just fixing the ledger account so that we just use the one that we had already made. The one that we had already made. Okay. Okay, so we were given our information and we were asked to present the depreciation, to calculate the depreciation first and present it in the accumulated depreciation and the depreciation account. So we bought the asset when? On the 31st of May, 2019. We must be very particular about the date we purchased the what? The asset, 31 May 2019. So the first thing that we want to do is to calculate the period for the period for each year. For the year ending 31 August 2019, we want to see how many months did the asset work. For the year ending 31 August 2020, we want to see how many months did the asset work. And the same applies for the year 2021. Note that we only calculate depreciation at the end of the financial period. At the end of the financial period, that's number one. Or when we sell an asset, that's number two, when we calculate depreciation. So in this particular instance, we are not selling anything. We are just calculating depreciation at the end of the financial period. So we bought the asset on the 31st of May, 2019, but our year ends on the 31st of August, 2019. So you want to calculate from May to August, how many months we have. So May is already done. We move on to June. So we say June, July, and August. That's only 3 months. That's only 3 months from June to August. And then we already know that our year, if our year ends on 31 August, it means it starts on the following day, the 1st of September. So from the 1st of September 2019 to the 31st of August 2020, we must know as accountants that there are 12 months there because each and every accounting period has got 12 months. So we already know that we've got 12 months there and we've got 12 months here. So what do we want to do? We want to calculate depreciation firstly for the 31st of August 2019. So what do? We go to our cost 305325. Before we apply our rate, we must ask ourselves why were we given the the VAT rate? Because in accounting, the VAT does not constitute the cost of the asset. And we want to apply the depreciation rate to the cost of the asset. We want to apply the depreciation rate 33.33%. We must only apply it to the cost and not the amount that includes VAT. So the first thing that we must do is to take away VAT from this amount. How do we take away VAT? We just divide this amount by 1.15. This is a matter of mathematics. So when we calculated for depreciation, I don't know if I should go on that right now. Let's save that for another lecture. But what we must know is that when we want to take away VAT from the amount of the asset, we just divide by what? By 1.115. So we come to say this amount here, we divide it by what? By 1.15. Okay, let me just say it. To get to this amount, we say the cost of the asset multiplied by the what? By the VAT rate or plus, we said plus VAT, plus VAT. So the short form for this is just saying cost multiplied by 1 bracket the VAT rate. The VAT rate once was 1.15. So we just say cost multiplied by 1.15. So for us to arrive at this amount, we said cost multiplied by 1.15. So we want to come back to the cost now. So we do the opposite of that. We divide by 1.15. So that's how we come to see the cost of the asset. So we know that the cost of the asset when we bought it, the cost of the asset when we bought it was 265,500 Rand. So you want to calculate depreciation for the first year. And I have said that we just apply the cost. Let me delete this. We just apply the percentage to the cost. So we just come on a sheet and say 33.33% of what? Of our cost here, which is now 265,500. So suppose you were given your VAT percentage as 14% here. If it was given as 14%, here you were just going to come and say divide by 1,14, 1,14 to show what? That it was 14%. But in this one, it was 15%. So 1,15 is fine as it is, 15% there. So we want to say 33.33%, which is also presented as 33 and a third, multiplied by 265,500. So we say 33.33% multiplied by 265,500. We will find that we've got 88,491. And we were told by the question to round off to the nearest rand. So it means we are not going to be presenting our answers with the commas in them. So at 31 August, at 31 August 2019, our depreciation charge is this one. If we round it off to the nearest rand, it just comes to 88,491 rand. So that is our depreciation for the period of 31st August 2019. But okay, before we do that, remember, this is only for 3 months. This is only for 3 months. So we should take note of those 3 months. We come here and multiply by 3 over 12. Multiplied by 3 over 12. We just multiply again by 3 over 12. And that becomes our depreciation charge for the first 3 months in which we bought the asset. So if we are going to round this to the nearest rand, it becomes 22,123 rand, 22,123 rand. So that is the depreciation as at the 31st of August 2019. So what happens to the depreciation? If we say cost subtract depreciation, we'll find the carrying value of the asset. So this is already for the next period, the carrying value of the asset. So we come and record our transaction, and the date is the 31st of August 2019. So the date that we use is always the date that is given in the question. In the narration I have said, we use the name of the other account. I just came to the debit side because I explained already that depreciation has got a debit balance. So you want to take what the depreciation charge here of 22,123 Rand. We come and record it here. The moment we record an event in one account, we are bound to record it in another account. And here we are going into the accumulated depreciation account, which I have said is the negative asset account, and put in the what? The value of the depreciation. And seeing that this is the end of the period, we should proceed and balance off our account. We should proceed and balance off our account because this is the one and only transaction in the period of 2019. So it balances with what? 22,123. 22,123. The totals should be the same as I explained, 22,123. Now we want to move on to the following year. So this is the carrying value. Take note that I have said that with diminishing balance method, we apply the rate to the carrying value. We only apply the rate on the cost in the first year in which the asset has been bought. But in the second and preceding years, we apply the rate on the carrying value. So it is necessary for us to know that carrying value first before we go on to calculate the what? The depreciation. And we have already calculated the carrying value here, which I have said the cost of the asset, subtract the depreciation for the first 3 months. And then we are left with the carrying value. So what do we want to do? We want to go and apply the rate of 33.33% to what? To the carrying value, which is now 243,377 rand. 243,377 rand. That becomes our carrying value, our new carrying value as we start the year 2020. So at the end of the period of 2019, we were holding assets, a non-current asset which was worth 243,377, and it was no longer 265,500 rand because we have adjusted for depreciation in order for us to show the true and fair value of the business. So to calculate 33.33% of what? Of 243,377. We found, okay, the formula is incorrect. I left the multiplication sign there. And then we find the depreciation charge for the year. So for the year that ends on 31 August 2020, it has 12 months. And remember, the 33.33% is for the whole 12 months. So as at 31 August 2020, our depreciation charge was 81,117. 81,117. That was our depreciation charge for the year 2020. We are not going to apportion it because in this instance, the asset was used for a full year. It was not used for only 3 months, as it was the case in the previous year. So we want to come and put our depreciation there. Take note that this which I'm doing by the side is a working sheet. So you must know where to conduct your workings and where to present your answers. This is a working sheet, and this is the presentation of the answer. So our depreciation charge for the year, we were told that we must round off to the nearest rand. Therefore, it becomes 81,118. 81,118, which therefore means that for the year ending 31 August 2019, which is the period that we have gone into, 31 August 2019, our depreciation charge is what? 81,118. So the narration, I have talked about this. We will go on to put the figures in the account. We go on to put the figures in the account. So the moment you put the figure, when you are doing the diminishing balance method, is the very moment that you should calculate the carrying value for the following period. So for the following period, our carrying value is going to be what? It's going to be the carrying value of the previous period, subtract the depreciation of this year. So you see that I said the carrying value of the previous period, subtract the depreciation of this year, we find the carrying value of when? Of this particular year. So when we go to 2021, this is the figure that we must use as our what? As our carrying value, and therefore we are going to apply our rate on this figure. But before we go to 2021, okay, let me correct this. This is as at 2020. This is as at 2020. Before we go to 2021, we need to balance our account. So we just add the two in this account, this one plus this one. We find the total there. this one plus this one, we find the total there. So what is on the depreciation account should always be equal to what is on the accumulated depreciation account, because what we are doing in one account is the amounts we are putting in one account are the very same as we are putting in the other account. So they must be always at par. That's how we know that we are observing the double entry principle. So we want to move on to the last period, which is 31st of August, 2021. And what is the first step is to calculate depreciation for that year. So depreciation, I have said that is the, maybe let me write on top here, carrying amount multiplied by rate is how you find the what? The depreciation charge. So we've got the carrying amount. The carrying amount is always the one from the previous period because that's the value of the asset as we talk right now. So we want to come and say 33.33% multiplied by what? By 162,259, which is our carrying amount is this date. So we come and simplify it, 33.33% multiplied by 162,259. We find that our depreciation charge for the year was 54,080 rand. So the moment we find it, we come and record it on our working sheet here so that we can be able to find the carrying value for the following period. But we were told to round off to the nearest rand. So this becomes 54,081, 54,081. And therefore, what do we say? Okay, before we do that, we want to record this transaction in the what? In the depreciation account and the accumulated depreciation account, because that was actually the requirement. So we come here, we give the narration accumulated depreciation of how much? 54,081, 54,081, and we balance off the accounts. We balance off the accounts. So do we balance? We say the previous amount plus the current charge. We find 157,322. That amount is the very same amount that goes in the total column on the credit side. And that amount is the very same that we must see if we also add here 157,322, and therefore we balance both sides. 157,322. So what's the next step? We want to look at the carrying value for the following period. The carrying value for the following period. So we come and balance here, and then we say the carrying value of the previous period, subtract the depreciation for this period, we get the carrying value for the following period. So as at 1 September, as at 1 September 2021, we had assets worth 108,178 rand. So this is the carrying value. Okay, let me do this. As at the 1st of September 2021. So what does this mean? It means from the time that we bought our assets from the 31st of May 2019 at the cost of how much? 265,500 after taking away VAT. Right now our asset is worth 108,178 rand. And this is due to what? This is due to depreciation, which is simply the loss in value due to wear or tear. Wear or tear is just the usage of the asset. So as we use an asset, it reduces in value, and we must account for that in our books of accounting. So why is it called the reducing balance method? Why is it called the reducing balance method? You will find that, okay, was I correct there? 81, 81,118, 81,118. Okay. So you find that we are applying the rate on the reduced amount of the asset. We are applying the rate on the reduced amount of the asset. To take, let's discard this one, the first one, because it was only for 3 months. It cannot illustrate what I'm trying to explain to you why it is called the reducing balance. And let's look at the 2 periods remaining, which is 31 August 2021 and 31 August 2020 and 2021. You'll find that the depreciation charge for this year, for 2020, was 81,118 rands. The charge for the following year was 54,081 rand. So that is a reduction, or there was a reduction in the value of depreciation from that which we had in the previous period. So as the years goes by, our depreciation charge becomes less and less. That is why it is called the reducing balance method. Remember, we are only applying the rate on the carrying value. The carrying value is the reduced amount from the cost, and therefore our depreciation is bound also to reduce, unlike the one in the straight line method, whereby our depreciation charge is the same for each and every year because we are applying the same rate to the same cost. This one, we are applying the same rate, but to a different amount now, to a reduced amount now, and therefore our depreciation is bound to be reduced. Hence, why it is called the what? The diminishing balance method. So those are the two methods of depreciation that we have, and that is all I can talk about in as far as depreciation is concerned for today. The rest we'll see if you choose for us to remain together in the following lectures. I don't know if there is anyone with a question, a contribution, a suggestion, or anything to say pertaining to today's lecture. If there is no one, then I will hand you over, you guys over to Mr. Noel, and then he will conclude the lecture. Mr. Noel, over to you, sir.
Yeah, okay, thank you so much, Mr. Ruben, for the wonderful lesson. I believe it was very informative to each and one of us.